Hey everyone, welcome back to the channel. I'm your host Ian, and today we're diving into the 1970s inflation nightmare, when housing turned into a go-to shield against rising prices. Let's start at the beginning, with the pre-1980 era, specifically the 1960s and early 1970s, when things felt pretty steady. Inflation in Canada was low and predictable back then. From the early 1960s, annual inflation hovered below 2%. For much of the time, creeping up to around 4% by the late 1960s. We're talking about a period where the economy was just simply growing. Unemployment was manageable, and the Bank of Canada kept things in check with modest interest rates. House prices reflected this stability. In the 1960s, the median family income was about $5,600, and the median house cost around $11,900. That's a price to income ratio of roughly 2 times. By 1970, things had shifted a bit, but not dramatically. The average home required a little over 200 weeks of labor in order to buy, which works out to about 4 years of the median income, or a ratio of around 3 to 4, so a little bit of an increase. Homes during this time were seen as affordable necessities, not speculative plays or investments. People bought them to live in, raise families, and build equity over time, without the frenzy we associate with today's real estate. That all said, things started to shift a little bit coming into the late 1960s and the early 70s. The early warning signs of inflation. Economists point to a mix of factors. Government spending ramped up on social programs and infrastructure, creating a boom that outpaced productivity. Monetary policy loosened to keep the good times rolling, which meant more money chasing the same goods. And by 1969, inflation had ticked up to just over 4%. And in the 1970s, it was still around 3.3%. But the trend overall was upwards. Then came the external shocks. The 1973 oil crisis hit hard when OPEC embargoed supplies, quadrupling oil prices almost overnight. Canada's inflation jumped to 7.5% that year, then spiked to nearly 11% in 1974. Food prices soared too, thanks to global shortages. People started feeling the pinch. Groceries, gas, everything cost more, eroding purchasing power. These weren't abstract numbers. Families saw their budget stretched thin, and savings accounts offered little protection because interest rates lagged behind inflation. This is where real estate entered as an inflation hedge. As prices rose across the board, Canadians began viewing homes and property as a way to preserve wealth. Why? Well, real estate is a tangible asset, bricks and mortar that tend to appreciate with inflation. Rents could be adjusted upwards and land values climbed as the dollar weakened. During the 1970s, real estate delivered about 4.5% annual real returns, meaning after adjusting for inflation. It still grew your money, outperforming stocks and bonds, which struggled in the stagflation environment. Now, stagflation, if you're wondering, is this nasty combo of high inflation and stagnant growth that defined the era. A second oil shock in 1979, triggered by the Iranian Revolution, pushed inflation back up to 9.1% that year, over 10% in 1980. By then, Canadians were piling into housing. Housing starts remained strong through the 1970s, with government programs financing nearly 40% of them early on. But private buyers jumped in too, seeing it as a safeguard. Data shows nominal house prices rising steadily. In Toronto, for example, average prices went from about $30,000 in 1970 to over $100,000 by 1980. Now, when you adjust for inflation, the gains were a little bit more modest, but the perception was that real estate would hold its value better than cash or other investments. Now, what did the people this time actually think? Sentiments were a bit mixed, but optimism dominated early on. In newspaper articles and reports from the mid-1970s, like those discussing housing and policies in the crisis, real estate was often hailed as a reliable store of value. With inflation eating away at savings, bank accounts paid maybe 5 to 7% while prices rose 10%. Folks reasoned that borrowing to buy a home just made sense, even if rates were climbing. Mortgage rates averaged around 10% in 1978, jumping to 14.5% in 1980. Many saw it as an investment that would forever appreciate, especially in growing cities like Toronto and Vancouver. Government incentives like tax shelters for rental properties in the late 1970s really encouraged this. Provinces introduced rent controls to curb gouging, but that didn't stop investors from seeing the potential. However, Not everyone was so excited about this. There were fears of overbuilding and speculation, and policy discussions like the 1970s housing crisis analysis. Experts warned that rapid price increases could lead to affordability issues for low income families. Some predicted a correction if inflation wasn't tamed, pointing to the US where similar trends led to volatility. Public opinion polls and editorials from the era ranked inflation as a top worry, and while real estate was a popular hedge, there were voices cautioning against assuming endless growth, especially as the rates kept climbing. The inflation of the 1970s and the 1980s and real estate matching and growing with it really showed the opportunity of real estate, showed that it was a good investment that would survive over time and hedge against inflation. The real question is that something that would last forever? In the next era, in the next crash, in the next situation, would the real estate prices hold? Catch me on my next video where I dive into the next cycle of real estate and what people were thinking of the time. Thanks for joining me, and I'll see you in the next one.